Welcome to Coffee and Crypto with Lee and Jimmie. I am Lee Reiners, joined as always by Jimmie Lenz. Jimmie, I have good news for you.
Yeah? What is it?
Your name does not appear in the Epstein files. Congratulations.
Thanks, Lee. I doubt yours does either. Not a shocker for me. I bet it is for some people.
Well, I figure you're a man about town. Who knows?
Not that side of town, buddy.
I said, let me take a look here.
You actually have been through those files, haven't you?
I've been searching a few names, a few folks that I had some questions about.
Did you turn up anything unexpected?
Well, I don't want to cause any controversies here at all, but there's some interesting things in there, no doubt about it. And some good. Most of the stuff is like completely mundane, and the issue is like when you search for it, because there's a search bar just right on the DOJ website. And it spits you back, like they said, that name is in any of the documents, it gives you the documents. Right. And a lot of the documents are just like, because the reporting is on emails, right? Between various famous people and Epstein. But most of the documents are not emails. It'll be like a term sheet for some fund he invested in, right?
Yeah.
And it's like, because it's like Duke, because obviously I was curious about like, okay, is, like to what extent is like Duke or Duke affiliated people. And there's reporting on Dan Ariely, the behavioral economist, and he's being investigated by the university, as I understand it. And he was exchanging emails with Epstein.
But there was more than just a mention of his name, from what I understand, right?
Yeah. I don't want to gin up any it's all out there. The student newspaper, the Chronicles report. I mean, it's been reported, so people can take a look at that themselves. And he's been in hot water for a while. I mean, he's been accused of academic misconduct and making up his data. And so he's kind of been under the microscope for a bit here. But, so for instance, like Epstein invested in the same hedge funds as the Duke Endowment did. Right, as like a lot of people did. So it's like
a lot of people probably did. Yeah.
So it's like if you just search Duke, like you might see something like that, which is like, or it'll be like resumes of various kind of funds or investments that he was making.
Right.
And like the manager of the fund was like went to Duke, and it's like that's on the res. So it's like, you're not going to find a. I was just curious,
Yeah. No, I mean, it's interesting, and I know you have a lot of experience coming through those kinds of things and looking for all kinds of. I'm going to just say it, nefarious conduct. And so no, it's. I would say I'm relieved, but I never had any expectation I would be in any.
Yeah, for sure.
Things.
Well. And we haven't talked about it on the show, and I didn't put on the agenda for today, but, look, he was heavily involved in crypto from very early stages.
Yep. I've heard that, he was investigated a lot of different crypto companies and different cryptocurrencies.
Well, the MIT Media Lab, he was, a big supporter of, and they were funding a lot of the Bitcoin core developers. So
they had that. Remember MIT had that big partnership with the Boston Fed even.
Yeah, that was after they did. That was on like CBDC stuff, but that was like after the kind of the early Bitcoin days.
Right.
And Brock Pierce, right, the Tether founder or co-founder, Epstein was quite close with him. It's been reporting on Epstein invested in Coinbase, so. He was definitely involved. He was involved in a lot of things.
He was an investor, amongst a lot of other things, but he was an investor. So, he was, I would think, being an institutional investor, you're always looking for opportunities, and your scope tends to be far and wide.
Yeah, that's right. All right, well, let's move on. That'll be our only Epstein related story.
Okay, that's probably best.
Unless there's still more documents to come.
Yeah, that's right. That'll be interesting to see what this last tranche. I don't know.
Yeah, man. Who knows?
Yeah.
Well, okay. Well, sticking with Epstein and former friends of Epstein, I guess the president of the United States, of course, is one of them. And he weighed in. He weighed in this week on, of course, the biggest sort of crypto story of late, which is the market structure bill. Right. And we have talked quite a bit about, of course, the main holdup there is the fight between the banking groups and the crypto industry over payment of stablecoin rewards.
Yeah.
The White House and Patrick Witt, who is the kind of the crypto advisor in the White House, have organized a series of meetings to try to hash out a compromise to no avail. And finally, this past week, Jimmie, the president weighed in, and previously he had been sort of silent on this specific issue. Obviously, he's been supportive of trying to get the bill over the finish line, but no one really knew where he stood on the third-party rewards issue. And he firmly put his weight behind the crypto industry on this on this one.
I don't know. To me, this is a little bit. I don't know. I mean, this is already down the road. I mean, I just don't see. And you remember we talked about this 3 years ago at Digital Assets Duke. I really don't see a difference between this and money market funds. I just don't. Yeah, are they more available? Yes, they're more available. But now with the Wisdom Tree's new tokenized money market fund, they're not even more available. I mean, it's the same damn thing, folks. They're invested in the same thing. The yields are paid out, just like they are in money market funds. I mean, it's more portable, but it's not even that much more portable anymore. I think this is a losing battle for the banks. I don't see it. And, banks were very concerned when money market funds started to get popular, and they said, hey, it's going to drain deposits. And you know what? It drained deposits. I mean, they're under
a very different regulatory environment with
different regulatory environment,
interest rate caps.
It is a different regulatory environment, but it's the way that they are controlled. The assets they can invest in and things like that are almost mirror each other. And so I would say, while it is a different regulatory, it's really not, because the requirements are the same. And at the end of the day, I think this one's. I mean, I think this is an argument that took place, 10 years ago, and people are just putting it in today's context.
Well, spoken like a crypto lobbyist there, Jimmie.
I don't know.
Well, you and I have both, for your opinion. You and I have both said repeatedly that both sides in this debate are exaggerating their claims.
Yeah.
Right. And of course, that's going to happen when you have this very sort of public, debate like this. I'm with you. I've said, look, money market funds haven't killed the banks, right? Per the Genius Act and the requirements around high quality liquid assets that make the reserves, it's the same assets that go into government money market funds. So in theory, at least, the rewards that exchanges can offer their customers for holding stablecoins on the exchange should be no higher than yields on government. Now, the law doesn't say that it can't be higher. So they could there could be some subsidization.
Yeah, they could,
right?
But that's just losing money.
I think that's one concern. And look, you could have the issuer themselves subsidize some of those rewards, right?
Yeah, but how long can you do that for? I mean,
not forever, but you got to scale. It's a network
but these places
effect
operate
thing,
on pretty thin margins.
It's like these VC, these VC backed companies, right? Like, pre kind of, in the ZERP era, right? It was like, free stuff, right? Like free door, when like these DoorDashes and there's like free rides, free DoorDash, right? That stuff was subsidized for quite a while.
Do you use DoorDash? Do you use any of those?
Rarely, very rarely.
I don't know.
I don't know.
It's like we live in a part of town driving around with my food in their car.
Huh?
That's different.
It's never good. Like, it's obviously worse that food is not, if you have a food in a styrofoam container for, 20, 30 minutes, it's not as good.
I don't ever use them.
We live in a part of, thankfully we live in a part of Durham where
you can go to a restaurant. You can walk to 50 restaurants in 15 minutes from your house.
I could just call and get it and just walk there and be home, or just eat it, so we're fortunate in that regard. So no, I don't do a lot of DoorDash. But I think to your point, Jimmie, it's like, okay, as stablecoins, how different are they than money market funds, right? And I think you did kind of hint at it, which is, well, there's sort of less friction and you can use them for payments because you can't use money market funds for payments. So if it's really easy for folks to hold stablecoins, use them for payments, and then of course they get yield on that, then I think that is a real risk to banks and deposit outflows. So there's sort of less friction and more utility associated with a yield-paying stablecoin.
If I was one of the banking lobbyists, I would be getting all the guys around me and saying, "Listen, this horse has left the barn. So why don't we, instead of, trying to chase this down, why don't we lobby to have stablecoins be part of our tier one capital? Why don't we lobby to get these as, basically liquid, high quality assets, and get them categorized that way, so that it actually plays, because the horse has left the barn. You're not going to get that. That's not coming back.
I don't think so. I think that. I mean, stablecoins are going to exist regardless, but I think the yield issue is certainly something that they could very successfully close via legislation.
I just don't see that happening. I mean, it's just I think that the fact that it's already being done,
all it takes is a run on one stablecoin, and the contours of this debate completely change, man.
I don't think, but the idea of a run is like a run on money market funds. You'll just sell the assets. I mean, these are the most liquid assets in the world. That's all it'll take, is they'll just sell the assets.
Yeah, no, Silicon Valley Bank had a lot of liquid assets.
Well, yeah, but their liquid assets were trading at cents on the dollar.
Well,
their treasuries, though.
Yeah.
Maturity mismatch. We'll, I gave a lecture on that last week.
Yeah, that's what banks do, right? Liquidity, maturity, transformation. Well, anyway, Jimmie, back to the story at hand here.
Yeah.
So the president
weighed in on it. Yeah.
Finally weighed in. He said, what did he say? He said the Genius Act is being threatened and undermined by the banks, and that is unacceptable. They need to make a good deal with the crypto industry because that's what's in the best interest of the American people. He went on to say that stable coins users should be able to earn money on their money. He said Americans should earn money on their money. This industry cannot be taken from the people of America when it is so close to becoming truly successful. So reportedly, and this was a post he put out on Truth Social, it happened shortly after he met one-on-one with Coinbase CEO Brian Armstrong. So as we've seen in the past with the president, it's sort of like the last person he hears from is the view that he sort of echoes and adopts, right? I don't know if this is going to move the needle at all. It seems as though that Senator Tillis, our home state senator, is on the banking committee, is pretty dug in on this issue. Now, obviously, we know, Jimmie, that North Carolina is a banking hub, right? Outside of
second largest banking center in America.
Second largest banking center outside of New York. And, Tillis has a lot of relationships with the banking industry. He is, of course, not running for re-election, and he's certainly feeling unfettered because of that. Because if you watched his questioning of former DHS Secretary Kristi Noem this week, he was fired up, man. I don't know if you saw that, but Tillis was.
I did not see it. But Tom has been, I'll tell you what, Tom has been like really, really vocal about a lot of stuff lately. He is.
Well, and it's so frustrating. He is, and I like it. Like,
I mean, he is. You do not have to read between the lines with Tom.
But it's so frustrating that, it takes these people, getting out of Congress or not running for re-election to actually speak their mind. Right. It's like, it would be kind of nice if we had some more folks who are willing to just be honest about the situation. He has been. Everyone's afraid of a primary opponent or whatever, or Trump getting a nasty tweet about them. So anyway, I don't know. Like, it doesn't seem as though, from what I've read, that that Trump weighing in on this is going to really motivate action at all. The banks seem pretty entrenched. So speaking of bank entrenchment, Jimmie, let's move on to the next story. Big story. Kraken.
Yeah, right? Huge story, right?
Very big. So Kraken has become the first crypto firm to get a Federal Reserve master account. Okay. And we talked about last week the comments that the Fed got on their skinny master account proposal. And the Kansas City Fed, apparently front ran, all of that and gave Kraken a master account. Now, Kraken, the specific entity, holds a Wyoming special purpose depository institution charter. Yep. It's a unique non-depository banking charter that the state of Wyoming created specifically for crypto firms a few years ago.
Back when they were a few years ago when they were, Caitlin Long was charging charging ahead to the Senate.
Who's heard from her? I should check her Twitter account.
I have not heard much from her.
How is she feeling? Because she's been in the trenches on this.
Oh, she's pioneered it really for Wyoming. I would say she
still doesn't have that master account.
One of the champions.
The Fed.
Yeah.
Yeah. So anyway, Kraken's got a master account now. It seems as though, Jimmie, that it is essentially a skinny master account in terms of the functionality and features. So no interest on reserves, right? I don't think it's coming with access to the discount window, right?
Well, I thought it did have access.
Does it? I don't. Yeah.
I thought it did have access.
Okay. Well, I'll have to confirm that.
Yeah.
But it's obviously a big deal right now. Kraken will have direct access to FedWire. So they'll be able to clear dollar payments directly, at the Fed and kick out the middlemen that it's been dealing with.
Right.
And this has, generated a lot of pushback from the banking groups, Jimmie. So BPI, which represents the largest banks, ICBA, Independent Community Bankers Association, which represents the community banks, smaller banks, and the American
a big supporter of digital assets at Duke.
And shout out to Brian Labrador. I know he listens to the pod, so I'm sure he probably fired off or contributed to their letter that the ICBA posted, and the American Bankers Association, which represents all banks, all put out statements expressing strong disapproval or concerns, right? Kind of language that they don't really use, certainly in this administration, about the Fed's decision to do this. And really their concerns revolve around the fact that we're still waiting for the Fed to finalize the rules around the skinny master account idea, right? And that it's sort of they're putting the cart in front of the horse here by approving Krakens. There's also concerns around risk management, right? These firms Kraken is not subject to the full suite of bank regulations like their banks are.
Right.
Concerns around AML naturally. So a lot of unanswered questions in terms of what went on here at the Kansas City Fed, the thought process, the considerations, what type of requirements were imposed on Kraken, and also, Jimmie, like in terms of what type of coordination is there? Was this something that the Kansas City Fed just did on its own, or was the Board of Governors involved? Because a few years ago, the Board of Governors did put out policy guidance to try to standardize the process across the 12 district banks for reviewing and approving master accounts, and it created this 3-tier risk structure. So if you're in the 3rd tier, you're going to be subject to the most heightened scrutiny, which Kraken would fall under that 3rd tier. So what are your thoughts here, Jim? I mean, are you agree with the banks, or are you saying, hey, this is a good thing, more competition in the payment system?
I think I like the fact that we're having not so much more competition, but an upgrade in the payment system. I think that is in banking, almost everything that we see that is around any sort of significant improvement, which I think is significant customer service bump, has come from outside the normal realm, right? Bank of America, Wells Fargo, Citibank, they're not coming up with innovative new things. They don't have to. They don't want to, right? They're expensive. They're already making a good living. They don't need that. When we saw, and I brought this example up before, but when you saw a really big ramp up in the way that mortgages were granted, where'd that come from? Rocket Mortgage, not even a bank, right? When you saw first online accounts come in, where did that come from? Came from credit unions. I mean, the community banks, credit unions, outside third parties, those have been where most of the actual innovation has occurred.
Yeah.
And so as much as, the Kraken thing has, it's obviously rankled a lot of people, I think the upgrade in payments, I mean, we've been talking about this forever. How do we get a better payment system in place, faster, more efficient, less middlemen? And I think it had to be something like this, because there was no reason for anybody else. Everybody else was, kind of falling in line. And yeah, I know Swift has their new payment system and stuff like that, but that's not for this kind of thing. I'm a huge fan of the fact that we're getting an upgrade in the technology. We're getting an upgrade in the way things are. It's happening. I do have a question for you. We have the regional Fed banks, right?
Yeah,
and
man.
they are supposed to act with some independence. They're not supposed to be just a bunch of guys sitting around the same table. They just live in different places, right? And so, I mean, really, I think that, and when I look back, and I'll tell you what the genesis of this was. I've been looking back at exchanges. Different kinds of exchanges that used to be around the United States. We used to have a lot of commodity and stock exchanges around the United States. Now we don't, right? We still have 50, but they're all virtual exchange. 50 places.
And they're owned by the same two companies. Yeah,
basically, yeah, they're the same thing. And so, we used to have a commodities exchange in Kansas City. We used to have, different kinds of things like that. And I'm wondering, and we've talked about this before, the consolidation of every industry in America, in the world, I guess, those kinds of things. Are we, we grew because of all this independence that we have. So whether everybody at the Fed agreed with this, or if it was, the Kansas City Fed taking a little bit of a flyer, I do believe in an independent Fed. I do believe that the regional Fed banks should have some modicum of independence. And so, and I think it's an ethos of America. I really do. I don't think that they should all behave exactly the same. So that's my thing on the approval of it.
Man.
But on the regulatory,
That's a hot take, brother.
Well, that's who I am.
A Stephen A. Smith level hot take for this podcast. Look, it's hard to. A lot of this goes back to kind of Jeffersonian, Hamilton debates, right? Look, it's just hard to run an economy in this digital era with, that kind of level of fragmentation. I mean, and the Fed has evolved over the years, and there's been legislation to bring more centralization. I mean, in the early days of the Fed, it was the district banks did monetary policy independently, right? Each district bank would set the discount window rate independently. And this became an issue in the Great Depression. And this is why Benjamin Strong was, Lords of Finance. I know you're a big fan of that book, right? You can't run monetary policy like that in the United States of America in this day and age, right? Similar to
you can't, but you can't. But so if you look at the Fed side of things, man, this is delving into another place. If you look at the Fed side of things, it's one thing. But if I look at regions, and I do look at geographic regions in microeconomics, I mean, you have vastly different rates for similar lending in different regions in the United States. Absolutely, you do. And I think we want that. I think we want that competition. I think we want that understanding of risk to be independent. I don't think, having everybody adhering to exactly the same rates, they see everything in exactly the same way. You know what you get? You get a contagion, a network contagion that is unstoppable when those kinds of things occur. I think that's one of the things that we need is we need to have that independence. So I'm a huge fan of the system that we have now. That's why we have 5,000 banks in America.
Well, you have that level of independence, you're creating more opportunities for capture too, right? And those district banks, they have boards, and one of the critiques coming out of 2008, which was a justifiable critique and a correct one in my opinion, was that that you had those district feds essentially serving the interest of their members because they're owned by the banks in their district, right? I mean, this is how crazy it was. Dick Fold, up until like a few weeks before Lehman filed for bankruptcy, Dick Fold was on the board of the New York Fed. I mean, that's obviously a huge conflict of interest. I mean, he was essentially forced to, and if you read the Andrew Ross Sorkin book, Too Big to Fail, right? It was, it was embarrassing for him, understandably so. It was an agonizing decision. He took a lot of pride in being a member of the Fed board. So Dodd-Frank changed that so that that certain members of Fed district bank boards that were from the financial industry could not participate or vote on the selection of the president. Right.
They had to be,
Yeah. And, similar with, bank regulation, kind of pre-Dodd-Frank, that was essentially done independently at the district banks. And Dodd-Frank really kind of centralized that. And the concern, again, was that The bank regulators had essentially been captured by the banks in their districts. So look, there are some trade-offs for sure. I am generally supportive of most of the power resting in the board with limited delegation of authority. The one area where you're still seeing that delegation at play, though, is in the master account decisions, right? And I think there's arguments to be made on both sides for, the district bank should have a wide latitude in deciding that. And, the other side is no, actually, that should be really centralized out of the DC Board of Governors. But when they, a few years ago, finally disclosed who actually has master accounts, because for the longest time, they wouldn't even tell you.
They wouldn't
tell you. So there was a law. So Senator Toomey, before he retired, he got a rider inserted into, I think, the National Defense Authorization Act that forced the Fed to disclose. And when they did, there was it was all over the map, man. There was no rhyme or reason. You're like, okay, wait, how did they get a master account? And they don't have one. And it made zero freaking sense. So I don't know. I think in the year 2026 of our Lord, you gotta have a little more sort of national
little transparency.
But anyway, let's move on, Jimmie. So another related story. Yes.
Give me a break.
Okay, I'll give you a break.
On top of everything else, I have a woodworker coming to finish some of the woodworking. And he actually showed up on time.
All right.
All right, let's go.
All right. Well, let's move on to another related story, Jimmie. Of course, we've talked about it before. When it comes to stablecoins and companies that want to issue a stablecoin, it seems as though the preferred route to do so is getting a national trust charter from the OCC. And of course, that's been controversial because the banking industry has said, look, historically, a trust charter meant that you were confined to doing just fiduciary activities, right? And it seems as though that, a lot of these new applicants want to engage in a broader swath of activity. And that spurred the comptroller of the currency, Jonathan Gold, a few weeks ago to put out a proposal sort of clarifying the ability of national trust banks to engage in non-fiduciary activities. That rule was just finalized, largely as it was originally proposed. And so that led to Brian and our friends at the
ICBA weighing in again. ICBA has been busy.
Brian listens. Brian listens. He's come to Digital Assets Duke every year, so I know he's got thoughts. Shout out to Brian down there, and I think he's in Greenville, South Carolina.
South Carolina.
Yeah, a classics major, I believe. So look at that, the value of a classics. What do you think Cicero would think about all this, Jimmie?
What would Cicero think? I don't know. We delved into what the core principles of America. Let's go back. Let's dial back a few more centuries.
Let's go even further. Well, of course they were inspired. The founding fathers were, of course, inspired by the classics, right?
Yep.
So So anyway, they came out with a pretty strongly worded statement, saying, look, we don't think the OCC has the legal authority here. They call on the OCC to withdraw the rule or reissue an amended proposal consistent with
its own statutory authority. It's going to be hard now since people have already been approved for it.
Yeah, I don't know. I don't know how you put this genie back in the bottle,
I think it's like impossible. I mean, well, maybe not impossible, but it's going to be damn hard. Once it's been issued.
ICB is going to sue. I mean, I get the sense that litigation is going to be forthcoming here.
With Morgan Stanley now jumping into the fray,
and then Morgan Stanley's in the mix too, Jimmie. Yeah. And Morgan Stanley is making a big digital asset push of late. Big digital asset.
Well, I mean, maybe trying to play catch up a little bit with the friends down the street.
Yeah, probably. I mean, it's a competitive industry, obviously. Yeah. So Morgan Stanley has applied now for a national trust bank. And they, according to the public portion of their application, intend to custody certain digital assets and conduct certain activities incidental to the business of banking, including the purchase, sale, swap, and transfer of digital assets to support client investment activities and facilitate customer staking on a fiduciary basis. So just the latest, Jimmie, but this is the biggest TradFi firm.
I think it's a natural progression. Large brokerage firm. So in the past couple of weeks, though, we've had a couple of things. They changed the haircut for digital assets, right? With stablecoins in particular. It went from 100% to 2%, which kind of maybe didn't incentivize brokerage firms to hold these assets, but it kind of did. And then on the heels of that, we've seen some other activity just in the past, week or two that would incentivize brokerage firms and more traditional financial institutions to kind of jump into the fray here a little bit. And I think that now, some of those folks are feeling like they have to play catch up, right? They're at this point where this is out there. It's not going away. There are more and more things that are, happening in the space. And then, kind of as of late, I think all of the talk and some of the discussions among some of the regulators and things like that about how digital assets are going to be treated basically the same as traditional assets, whether it's traditional or digital. The asset's going to be treated in the same way. It's like if I'm not doing this, if I'm not in this space, then I could actually be at a negative. I could be at a disadvantage if I can't handle these assets. If I can't custody them. I mean, there are going to be assets that I can't use that my competitors can.
Yeah, fair. Yeah, there's definitely a sense of urgency here, and I don't think Morgan Stanley is going to be the last TradFi firm trying to get the National Trust Charter.
Absolutely not. Right? Absolutely not. I would expect that they are the first in a string of brokerage firms that already don't have banks. Now, most brokerage firms are owned by banks, or they've set up special kinds of banks to hold certain kinds of assets in and things like that. I'm thinking Goldman in particular, but there are other brokerage firms out there that are not banks that I would think this. I mean, I think we talked about it a few weeks ago months ago when this notion first came out that this was likely going to occur, and here we see it. I think they're the first in a long line of brokerage firms to go down this path. Don't you?
Oh yeah, for sure. I mean, it's been just the volume of announcements amongst those who want to issue stablecoins or get a national trust charter. It's frankly been overwhelming just to stay on top of it. And this is a weekly podcast, okay? And it's not stopping folks. And he's approving them, right? The OCC is approving them, most importantly, right? Or at least conditionally approving a lot of these. So something to keep an eye on going forward. Another regulatory story, Jimmie, that could potentially be big is that it's been reported that the SEC has submitted for review to the White House, specifically to the White House's Office of Information and Regulatory Affairs, OIRA, which sits within OMB. And they essentially, that's the group that kind of vets and reviews proposed rules that agencies want to put out, right? Or guidance. Now, historically, the financial regulatory agencies were viewed as independent and not subject to OIRA review, but the Trump administration has tried to kind of consolidate and centralize more authority, whether it's constitutional or not, we're, TBD, I guess. But the SEC and other agencies are playing ball and submitting stuff for OIRA review. Anyway, what they have submitted, though, is called Application of the Federal Securities Laws to Certain Types of Crypto Assets and Transactions Involving Crypto Assets. So we might finally have, and we're not sure if this is going to be commission level guidance or an actual rulemaking, but sort of codifying the token taxonomy that Atkins has hinted at and discussed in other speeches he has given, right? So we've been talking forever about how does Howey apply or not apply to digital assets. We might actually have a rulemaking forthcoming here, Jimmie.
Well, it would be nice to see that. Again, I don't think you can throw all digital assets in the same bucket. That's the problem.
And that's what I think Atkins is trying to acknowledge here.
I think you have to, because you and I use that nomenclature too. I mean, a lot of people do, digital assets, but digital assets means just a ton of different things. That's like saying, just assets. I mean, what kind of assets? It's like, it could be anything. And I think the same thing is here with the digital assets. And so having some sort, having more definition, I think, obviously Genius went a long way to starting down that road of this is what a stablecoin is. Okay, it's got to meet these. I think we're going to have something very similar with all kinds of digital assets. I think we have to, right? Yeah. And so, once, but I don't think you can start making rules about something that's not defined yet. I think you have to define it first.
Yeah, and there's always the story behind the story, right? It's kind of the Howard Marks, there's second order thinking, third order thinking, right? I mean, he talks about it in the investing context, but it applies, also to the policy and regulatory context. Because the question to Jimmie is, why hasn't Atkins already done this? Right? I mean, he's been in the job for at least a year now. Right, I think a year.
Probably around a year. Probably just a
year.
There's a lot of stuff going on in the last year.
He was obvious, and like Commissioner Peirce and Commissioner Ueda, have been at the SEC for quite a while and have thought deeply about these issues. And Commissioner Peirce floated a number of different proposals when she was in the minority under Chair Gensler. So you kind of would have thought that they would have had something sort of ready to go out of the gate. And I think the issue, Jimmie, and this is just speculation on my part, is that they didn't want to front run Congress in the market structure debate, right? Because if the SEC codifies, this token taxonomy concept, you could easily see a lot of folks saying, well, why do we need legislation if the SEC is sort of providing guidance in terms of what digital assets are securities, are not securities, right? Then, kind of mission accomplished here. I mean, this is presumably the whole goal of market structure legislation. So I'm reading the tea leaves here and thinking, okay, market structures legislation has stalled. The industry seems to be getting antsy. We don't know if it's going to happen. We're getting very close to midterm season when everything shuts down, right? And so maybe they're just finally like, you know what, screw it. Let's go ahead with this rulemaking. And finally provide some degree of regulatory clarity. And now, obviously, I think that the rules have been clear, but I'm talking from their standpoint. Let's just provide the regulatory clarity that the industry's been clamoring for and see where the chips fall. But that's just a theory of mine. But I think the timing here is quite interesting.
Yeah, I mean, I think the timing is interesting. I think there are certain things that are out there that we're now starting to starting to see bubble up on both sides. I mean, typically, as you said, the regulatory side shouldn't front run Congress. And so we're at this, we're at this place now where if it's not going to happen in Congress, as you said, there's a lot of people out there, they're looking for some kind of guidance. The SEC can provide that. Again, even if they provide the guidance of what is a particular kind of asset, does it mean that they're going to have purview over everything that they define? I mean, I think that would be normal. That's the way we would think about it. Should all these be under the SEC? I don't know. I don't believe so. But I think it goes to the fact that, and we've talked about this a million times, that until, there are some kind of firm guidelines around, different types of securities. and there are different types of assets, whether they're securities or not. But this is, I mean, for people that don't delve into the digital asset world a lot, I mean, there are a lot of different kinds of assets there. And, a lot of them do not have a, something that you can analogize them with in traditional finance right now.
Yeah, no, that's true. So I think the thing I'll be watching for is when this comes out, how closely does it adhere to some of the definitions that we have in the current, like the Clarity Act, for instance, or the current versions in the Senate around, network token, ancillary assets, things like that. I think my guess is that it'll be very closely aligned with those. But yeah, it's a very, very interesting development. All right, Jimmie. Well, as usual, we left a lot on the cutting room floor here. Yeah, that's all right, man. So look, I hope you have a great weekend. We didn't do our weather spiel, but we got amazing,
getting nice out. The weather's getting nice out.
Amazing weather here. Spring as we said before.
Spring break at Duke. That's this next week.
Spring break at Duke. That's right. So to all of our students who are listening, have a safe and enjoyable spring break.
Be safe out there, folks.
All right, Jimmie. Take care.
All right. Have a good weekend, Lee.
All right, brother.